Hey everyone, it's John. It's June 9th and time for the general market update. Reminder, the presentation is made by Rain King LLC, and I'm an amateur individual growth stock investor not affiliated with IBD or MarketSmith. So here's our agenda. We have a lot to go over today, and as I tweeted, the market can change on a dime and we need to be pretty flexible. So we're going to talk about the indices, the tone of the market, where the leadership is, some of the groups, and talk about the potential pullback, and then wrap up. So let's look at the indices first. So this is the S&P 500 weekly chart as of yesterday, June 8th. And it's probably worth noting I'm recording this on June 9th at approximately 10:30 a.m. and the markets are currently up. So this weekly chart shows us that the bear market, which bottomed out in October, yesterday we actually have now a 20% gain from the closing low. And the question is the bear market over? So here's some data. This comes from Carson Research. They actually have some data on when a market comes up off a bear market and gets up 20% off those lows, what happened next in the S&P 500? So they show a whole bunch of bear markets, and the real question of the data was that the real bear market low, or did the market eventually go lower? So you can see generally the 13 times it's happened prior, 10 of the 13 times the market went higher and never retouched or undercut the previous low. There are 3 exceptions to that, and they actually occurred during pretty deep bear markets. So let's look at those on a chart. So here's the Carson Research chart. The green dots are the successful cases, and then the red dots I put in these boxes around are the cases where the market actually went back and undercut the low after it was 20% off the initial low. And you'll notice that the unique part about it is these periods were very, very severe bear markets. By severe, I mean the decline. They're almost 50%, and the great financial crisis bear market was over 56% in the S&P. So those are the ones that actually failed. And just as a reminder, the S&P corrected about 27% in the 2022 bear market. So let's get into the market tone. So this is the New York Stock Exchange advanced decline line as of yesterday. You can see that we have finally broken this downtrend line, which is a good first sign. You can see the index in the top panel is making some highs, but we really want to see this improve even further. We certainly need to clear the April highs, as well as we'd love to get back to clear the February highs. That would help us build more conviction that there's more strength under the surface. New highs, new lows, the net number as of yesterday. This is again the New York Stock Exchange, much improved this week. Last week we had nothing going on. At least we're starting to see net new highs, so that's encouraging. Same type of chart for the NASDAQ, net new highs, new lows. Again, there's improvement here. We hadn't had net new highs in a very long time, but these still need to continue to see if this bull market leg can really take off. Now, last week when we spoke on June 2nd, I showed this slide and I was concerned about we were seeing bad breadth on up days, and we pointed out some data on that. Here we are a week later, and now we're seeing good breadth on down days, which is a sign of strength under the surface. So I've pointed out a couple times in some tweets, Tuesday, the S&P was only up 0.24%, but the breadth of the market was really good. We had 4-to-1 advancers over decliners. On Wednesday, the S&P was actually down 0.38%, but we still had 2-to-1 advancers over decliners. Very positive to see that the market is starting to broaden out. And the net new highs, the absolute new highs on the NYSE and NASDAQ last week at 155, 152 were actually the highest new highs we had in 2023. Another positive sign that breadth is improving. So that's really good sign. Another subtle sign that if you watch closely, some earnings reactions have had gap downs or steep sell-offs before the earnings came out. And we're starting to see the tone change. We're starting to see what I call snapbacks. And you'll see that those are subtle signs that the market may be shrugging off bad news and short-term reactions, which could actually be very, very bullish. Here's just a handful of them that we've seen this occur in. The first little mini chart here is snowflake. And you can see it was forming a base. It kind of tried to break out, and then it had a really bad gap down on its earnings. But you'll notice that it really recovered quickly with a quick snapback and had really what effectively was a shakeout. So it's still struggling a little bit at the breakout level, but it's a good sign to see this. We weren't seeing this type of snapback action at all in 2022. Here's Duolingo. This is another one that had a sell-off before the earnings report. Then we got the earnings report, and the stock snapped back very quickly with this shakeout. Coincidentally, this was the original breakout line. The shakeout came down to the breakout line and then reversed. Again, positive action that maybe the tone's changing. And here's Fortinet. Again, here's the line of the breakout. Before the earnings, they had a sell-off that took us actually below the 50-day moving average. We had a quick snapback to get back up around the breakout level. So it's subtle, but it's showing some improvement in the tone. Now let's look at the market leadership. Clearly, the semiconductors and the AI theme is leading the market. This is the semiconductor SOX ETF. And a couple of weeks ago, we actually had an 11% gain, which was the best weekly gain ever in the SOX. Now, according to Sentiment Trader, who has some data, on 5/26, the daily gain for the SOX was actually 6.5% daily gain. And their data shows that when you get a day of 5% more gain in the SOX, a month later, the ETF was positive 70% of the time. So it speaks to odds that things are strong, and there's a strong possibility that it may continue. So we want to keep our eyes on the leadership, such as the semiconductors. This chart is from last week, where we showed NVIDIA, Supermicro, and Rambus, which were extremely extended, and some of them have become even more extended, such as Supermicro. The importance of this is these are certainly showing that they're the leaders, but we want to watch what happens on the first pullback and consolidation. We want to look at that closely to make sure we can see signs of accumulation. So let's delve into some group relative strength. This is from MarketSmith, and I just did a quick sort on groups. So I actually looked at the groups, and I just sorted them from the top group, number 1, and this goes all the way down to number 20. This is as of Wednesday. So 1 through 20. Now, what's interesting about it is in yellow, I've highlighted a number of really strong groups that are actually moving up in the rankings. And what I mean by that is here's the 6-month ranking, the 3-month ranking, and then this past week. So hardware has gone from 47 to 31. This acceleration is showing us the money is moving into these groups. Internet content. So I've highlighted these in this red circles. Builders, special enterprise software, and the semiconductors. So this is really, really positive. Now you'll notice that the group in the top 20 is also dominated now by growth in techs, which is a very, very positive development. We did not see growth groups at the top of this chart in 2022. So it's important. So this is where you might want to be looking for names if you're not exposed to the market yet. So I cut a couple of group charts. Here's the group number 4, which is the computer software database group. You can see that it's been really, really strong since the beginning of May. And here's a couple of really strong names. You can see it. MongoDB is probably the strongest in the group, Confluent, and even Oracle, which has a number of AI themes going on within it for its recent strength. The RS is very, very strong for these. Here's the computer software special enterprise group, which is ranked number 6. You can see HubSpot, Double Verify, and others. Very, very strong action since late April and early May. Again, a place you might want to look for some names in the group. And the building residential, the home builders, are still group number 5. And they have been very, very strong all year. Probably looking forward 12 months out when we might start to get some rate cuts. But look at Green Brick, Taylor Morrison, Pulte, Toll, these are all acting very, very strong. They've all rebounded and snapped back to new highs this week. So let's talk about the potential for the pullback. Now, we want to anticipate this. We want to really ask the question, is this uptrend for real? And I've always said that you learn a lot more on the eventual pullback than you do on the surge higher. The second half of June seasonally tends to be weak. So a pullback would be kind of considered normal in the second half of June. Now, looking at the charts, we can see that the initial thrust that we've had is fairly narrow, and it was really dominated by the Qs and the AI theme names. So what's happened this week? Well, this week we got our first sharp selling in tech on Wednesday. And actually we seem to have bounced back well on Thursday. And today we'll have to see, we'll close on Friday. But the first sharp selling is fairly normal after a really extended run-up. Now, the really positive sign is we're seeing rotation. As money may be coming out of the Qs a little bit, it's being rotated into the small caps and the mid caps. And I tweeted about that. And they've burst higher. They've had 3 to 4 or 5 days, a very strong week. That's a very, very strong sign to see rotation into those groups because it's showing a broadening of the rally. Now, we've also seen follow-through buying in some of these moves, and we're seeing follow-through buying to breakouts, something we hadn't seen in 2022. That's positive change. Stocks above the 200-day moving average, we looked at that and see sharp improvement. Still needs to get better, but it's a start. And the net new highs, we're finally in net positive territory on the net new highs, but we want to see that continue to see the rally continue to broaden out. So it's this X-ray of the market that's next. How do we look at this pullback that we might get? So things that I'm going to look for in the X-ray of the pullback is, do the leaders only have small givebacks? We talked about the semiconductors and how they're so strong. Now, we want to watch how they pull back. Do they consolidate? Did they move sideways? Did they only give back 10, 15%? That would be constructive. Do we get support when the market pulls back? And do we see more signs of breadth improving under the surface? That would be very positive to see in the context of pulling back. And there are a number of levels we can look at. 4,200 on the S&P, we can look at the 20-day EMA, and we could look at a 3 to 5% percentage pullback as being considered very, very normal within a bull market. So how would these look on an S&P chart? So here's the S&P, and I've put on some potential levels for pullbacks. So we're approximately up at this level here, which is a natural resistance point for the S&P. If we pulled back to the prior resistance area at the 4,200 level, that would be in this zone that I've highlighted in yellow. That'd be very, very normal. Ironically, the 20-day exponential moving average in purple here is in that zone. So that could be a very normal situation to come back to the 20 to get some support. We could just pull back all the way 3%. 3% would be very, very normal. And if 3% pullback would be approximately the 50-day moving average in the 41, 47 level. Again, that would be considered really normal. And even a 5% pullback, which would bring us down to this area I've designated in the red line, which was actually the most recent low we had back in early May. If we came back down to that 40-50 level in the S&P, I still would consider that on a percentage basis to be very, very normal after some of the movement that we've had the last couple of weeks. So if the market, and I use a big word if, it may continue straight higher, but if it pulls back, we may get some consolidation. We want to see it act normally and show some breadth improvement, and maybe we'll get another push higher. I've highlighted in purple an 8% pullback, which would be in this zone here, back down to 39.47 area. If we got an 8% pullback, I would not consider that to be great. It's kind of a deeper pullback. It just might mean that we're going to go sideways a little more and chop around if we come all the way back down to there, because we've broken some of the uptrend. So that would be a concern to me in the short term, maybe not more in the intermediate term. Let's try to summarize all of this. Again, the breadth is improving. That's a really positive sign. The NASDAQ and the Qs are becoming very stretched, so we want to watch them as we potentially could pull back. And again, we just talked about it. We're going to watch for clues on the pullback. Anywhere between 3 and 5%, I would consider to be very constructive, and then hopefully it'll reveal the support under the market for another uptrend leg. We're going to watch those leaders carefully and see if we're actually getting support that the institutions are truly accumulating positions. Anything deeper than 8 to 12% would be a setback and negative in the short term. Doesn't mean we can't consolidate, chop sideways for a while, and still go higher. So I certainly think that increasing exposure levels a bit's warranted. Somewhere in the 20 to 50% level seems right to me. And I would just emphasize again, don't chase extended stocks. The semiconductors are way up there. I know they're tempting. I know they're in the news, but use your discipline. Wait for a proper entry. Wait for a base. Wait for 3 weeks tight. Wait for a consolidation of some sort to give you a proper entry. So the quote of the week is, we're not in the predicting business. We're in the interpretation business. What does last week have to do with anything? And that's from the GOAT, William O'Neill. And really, it's important to note, conditions can change on a dime, and we need to be flexible. Things didn't look so good 2 weeks ago, but they're looking much better right now. So be flexible and look at the market day to day. Reminder, I'm giving a special lecture series on Jesse Livermore and special lessons. It starts next Tuesday, June 13th. If you haven't signed up, please just go to my Twitter page. It's pinned tweet. You'll see the link to register for the event because seating is limited. And if you can't make it live, this event will be all recorded. It's 3 volumes, and you'll get all the recordings, and you're going to get over a 150-page PDF of all the slides. So I think it could be quite interesting. If you go to my YouTube, you will see a 2-minute overview where I'll explain what the series is all about. And this is actually just a teaser page. This is an example of one of the things I did. I've never seen a book on Jesse Livermore chronologically put together all of his activities. So this is a page I cover from 1877 to 1940 in this format, where we look at all of his activities along a chart of the Dow. We look at his personal life, ups and downs, as well as some of the key things going on in the United States history. So if you're really interested in this and seeing this all come together, and we'll pause for key lessons along the way, I think you'll like the lecture series. So hopefully you can join us. We're going to start next Tuesday. So that's all the time we have for now. That's the general market update for June 9th, 2023. We'll see you all soon on the next one.